Here's some advice for investors who are sitting in the markets, seeing them at all-time highs and not really sure, what do I do? Number one, welcome to Life in the Markets. My name's Tim Russell, and today is August 4th, 2025. It's been a very interesting week within the stock market and the economy. So the first thing I think is helpful to recognize is that while it's been an interesting week, over the last few weeks, the thing that we've been saying is the market's had a generally positive week. And you know what? This week, except for Friday, it's been a generally positive week. And then Friday happened, and we are sitting at about a 2.4% decline in all the major indexes. The S&P 500 and the NASDAQ especially are down all around about 2.4%. So the deadline for the tariffs was August 1st. That was just last week. And we have seen some positive movements with China, so we're paying attention to that. We're looking at some trade announcements hopefully coming out over the next couple weeks. There are just a few major trading partners that we're still looking to put a ribbon on any kind of tariff trade deals. Mexico and Canada, we're still working on. I think there was an extension to the Mexico deal. Canada's still playing a little bit of hardball, and we're still making progress with China. China, we also do have an extension with them to get us a little bit more time to work out the details. It'll be very interesting to see what happens. Interestingly, there were a number of good updates to some of our trading partners. One of them, India, got hammered by Trump this week because their ongoing trade with Russia and their energy that they're importing from Russia. So the Trump administration is punishing them for that. So it'd be interesting to see how developments work themselves out here with India as a trading partner. All right. Moving on, frankly, there were a couple other big news stories this week. The first is we got the federal funds meeting. They released their decision whether they're going to change the interest rate, the federal funds rate within the broader economy. Now, this came out, I think it was Wednesday, and the Fed decided to keep rates steady. This was not a big deal. We're all kind of expecting that. The expectation for a rate cut is increasing. In fact, it looks like roughly 80% of economists predict a quarter point cut within next month, the September Fed meeting. So again, we're watching that. Remember, when the Fed cuts interest rates, this is a base rate that affects lots of other interest rates within the broader economy. A cut to interest rates affects people who have money in the bank, in savings accounts and CDs, money markets, things like that. Those rates tend to lower as rates go down. Rates going up are good for depositors. On the flip side, as rates go down, generally and historically, that's been a positive thing for borrowers. Interest rates on loans tends to go down when this happens. So we're going to be very interested to see, does this help mortgage rates go down? What's been very interesting over the last year or so is that changes to the federal funds rate has not really had the same kind of relationship with mortgage interest rates. So I'll be very interested to see, does that continue to play out where the Fed might lower rates, but mortgage rates don't decline very much? Again, that's something that's yet to be seen. Forgive me for talking about this so much, but one of the most important interest rates is not determined by the Fed, but it's influenced by what the Fed does. It's called the 10-year Treasury. The 10-year Treasury yield went down this month. It was at a high of 4.4 this week, 4.4%. It's declined to about 4.2. It doesn't sound like a lot. In a bond world, that's actually a fairly meaningful move. A lot of that came down on Friday, and a lot of that was due to the jobs report that came out. So what exactly did the jobs report tell us, and why did that cause bond yields to decline over the 10-year Treasury? Well, what was really interesting is that, generally speaking, just by the numbers, we still gained jobs. We had 73,000 new jobs added last month. Well, you would say, Tim, that sounds like a good thing. It's not like unemployment's picking up. Why would the market respond negatively? Why would the bond market have a problem? Well, it's because of this. We expected 100,000 jobs. We only got 73. So that is a 36% or 26% decline, 27% decline from what we expected. The other factor is that they didn't just disappoint on the number of jobs that we expected, but they also revised the last 2 months' numbers down by a substantial margin. They decreased the jobs picked up in May and June by about 240,000 jobs, which again is a meaningful number. What this ended up doing is it ticked the unemployment rate just ever so slightly higher. I believe we're sitting at about 4.2% unemployment today. All of this has caused the markets to have a little bit of a tizzy on Friday. We saw the stock market decline, all the major indices declined. So that caused, I think in some ways, it caused the expectation for future growth, both within the economy and within the broader markets, to dampen, which is why the 10-year, in my opinion, this is why the 10-year dropped a little bit, because there's a little bit more of a sober expectation about the future. Okay. Moving on, we're kind of getting through earnings season. We're roughly halfway through the earnings season. I think actually we're, about 80% of the companies that have reported earnings so far have exceeded their earnings expectation. That's nice. 60% of them actually beat their revenue expectation. So what we're seeing is that companies that are reporting their earnings, roughly half of them so far, the vast majority of them are providing good news, which is in part why we're seeing the markets generally doing well. But I think what we have to keep in mind is a sober realization that we're sitting today at all-time market highs. And as an investor, we need to take that into consideration. So before I kind of get into some advice for investors, I'd like to say that there are a few earnings that we're looking for with keen interest right now. We've got Berkshire Hathaway coming up. We've got AMD, McDonald's, Disney, Caterpillar, a number of large and important organizations and companies that, again, will be helpful to see how are they doing, how is their business developing with the fears and concerns of tariffs, and what do they have to say about those things in relation to the health of the American economy and possibly even the health of the American consumer. All right, here's some advice for investors who are sitting in the markets, seeing them at all-time highs and not really sure, what do I do? Number one, if you are still investing, you are maybe putting money regularly into your 401k, your retirement plan at work, your Roth IRA, what I want you to do is keep on keeping on. You're doing a great job. Don't worry about little news that comes out that says the economy might not be as strong as it was last week, or one thing or another. I wouldn't worry about any of the things that I talked about with the unemployment rate or with the federal funds rate. Those things aren't going to affect you long term. Those are very short term in their scope. Keep a long-term perspective and keep on investing. Your dollar cost averaging, it is a good thing for you. Long-term, we still have very positive expectations for the economy and for the stock market. All right, the second group of investors are investors who maybe they want to raise their risk level a little bit, or who have a large sum of cash on the sidelines that they're like, hey, the market's doing great. We're past some of these concerns with tariffs. Let's get that money in the market. To that I say, remember, we are still at all-time highs. I would be very cautious about putting large sums of cash directly into equities at this stage of the market. That's not to say you shouldn't do it, but I would take a modified approach. I would say if you have, let's pick a number. Let's say we have $50,000, $100,000. Let's plan on putting that money in the market over the course of the next 6 to 12 months. We'll transfer, I say you can transfer a portion of that money into the market every, say, the 5th of the month over the next 12 months, and it gets the money in the market. You have a plan to get it in the market, and we're not just putting it all in at today's prices. This may help you be able to get an average lower cost per share than if you just invested it today. And while the market does have a tizzy, we do expect it at some point, you can choose to say, hey, I'm actually really happy with this price. Let's go ahead and put it all in the market at that point. So keep your powder dry, look for an opportunity to invest more. In fact, that's even good advice for the first set of investors, those who are regularly investing over time. It would be good to keep some powder dry so that if and when we do have a market downturn, you can take advantage of some lower cost shares to add to your portfolio. The final group of investors are investors who are in distribution mode and or those who have a large cash need over the next, say, 6 months, 12 months, 18 months. If that's you, the market's at all-time highs. It would not be inappropriate for you to refill your cash buckets. If you are taking your distributions, refill some of that cash now. That's a good idea. If you've got a house to buy or a college to pay or some other larger expense coming up, I would go ahead and maybe raise that cash now and have it sitting aside so that when you need it, it's there for you. It's not a bad idea to take advantage of the prices where we are at today. And I would encourage you, if you are working with us, if you're working with a financial advisor, reach out to us, reach out to your financial advisor, and have them help you get a plan for how to put that cash to work in your portfolio. All right, I hope that was helpful for you as we think about what do we actually do as a steward at this phase of the market. Now, as we close today, I just want to point out to you a verse that I'd like for you to think about this week. It comes from the book of Proverbs, chapter 19, verse 17. And the proverb says this: "Whoever is generous to the poor lends to the Lord, and he will repay him for his deed." This may seem somewhat disjointed from the theme of the discussion today. But remember this: whose assets are these? They're not yours. They're not mine. They're God's. And He's given them to us for a reason. Yes, to provide for your needs and for the needs of your family. That's absolutely part of it. But to provide for those who are less fortunate than you as well. God cares about those who are less fortunate. He cares about the marginalized and the widow, the stranger, the poor in your land. So, as you give to the Lord, as you lend to the poor, you are being generous to God. And God is one who always pays back His loans. Now, again, God's not borrowing money from you. He's never in a need. But when we do give to those who are in need, it's as if we were giving it to God. And God is such a great and loving God. He will repay. So remember that today. Be generous. Look for an opportunity to put God's wealth back into circulation. And in so doing, you prove your faith to be genuine and Christianity to be a real powerful force for good in this world. Thank you so much. Thanks for listening. Have a great week. Be safe in the markets.
The topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. Securities and advisory services are offered through Genius Wealth Management, member FINRA and SIPC.